Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. Busy week, and I would say, we're on the tail end of earnings. We do have one company that I'd be interested in looking at this week, but they're not going to be announcing until the close on Thursday, and that's Adobe. They're kind of an AI play. They've had a big run up recently to go, hand in hand with what Nvidia has done. They're not at their highs, but interesting stock that we'll take a peek at the end of the week. Right now, on Friday, we looked at a bearish trade in the QQQs, talked a little bit about the seasonality of the marketplace and where we are in September going into October. Oddly enough, we haven't had a strong September, but the VIX doesn't really show a lot of nervousness. And today, just to point something out, I guess because it's worth pointing out, we do have the NASDAQ is up about 0.4%. And then we have the S&P 500 up about 0.3%. And the Russell is up about 0.5%. So we have a decent up day in the markets. Obviously, on Friday, we bought a put in the QQQ, and ideally, we'd like the market to go down, but it's not really being hurt. We got a lot of time in our paper trade that we put on. It's going out until October 13th is what the expiration date is. And the one thing that I do notice, though, is that the VIX is up 2.5%, though. So we have the markets being fairly strong on the open, and yet we do see the VIX climbing a little bit. So for the first time, the VIX is kind of reacting the way that I would expect it to react in September. Very rarely do you have an up market and do you actually see the VIX index actually go up in volatility. And it's it's up 33 cents, trading at 14.17. Still low relative, I think, to most years in the September month. It's still fairly low, but interesting, right? So we do have a Fed meeting that's going to be starting on the 20th of September. Fed is anticipated to do nothing. Right now, there's about a 7% chance, according to the CME Fed Watch tool, that the Fed will raise interest rates 0.25%. If you go out to November, looking at the November futures option contracts, the Fed Watch tool prices that 0.25% increase at about 40%. So looks like the Fed is probably going to do nothing this time around, but there is still a decent chance that they're not done raising interest rates based off of the Fed Watch tool. And then the thing that makes me the most nervous, and this Friday I was on Volatility Views with Mark Longo over at Options Insider and Mark Sebastian. And one of the biggest things that is happening at the end of the month is we're going to have the end of the fiscal year in the fiscal year at I can't believe I just said that and they'll have some budget talks. Now, this isn't as scary as the debt ceiling, in that if we don't raise the debt ceiling in our government, there's everything just shuts down. But there's risks that some areas of the government may get closed down. And I think this is a little bit to do with, and I don't want to get into politics too much, but the thing that makes it a little nervous is that McCarthy, when he needed votes to become speaker, made some concessions, and a lot of them were on the conservative side. And one of the things I think they're going to really be targeting is certain aspects of the budget and the spending. I'm not saying if it's good or bad on either end, but it's good. It's bad for the economy if areas of the government get shut down. And there might be some short-term pain if that does happen. And I think that's what people are maybe a little bit more nervous about. And everybody kind of looks for that tipping point in September and October. And that may be the news item that can actually tip the markets and send them south. So always nervous. It seems like bad news is always worse news in September and October. Markets react. No rationale as to why, but it seems like markets react to bad news much more violently in this uh, calendar month, September and October. Okay. So let's take a quick peek at the QQQ trade. Now we're going to come back to it. We got a longer term trade. We bought an out of the money option. So we aired as far as time is concerned. And we're looking at the 368 strike. Right now it's trading just above $5, 505 on the ask, 502 on the bid. On Friday, when we captured the paper trade that we were looking at, it was at 554. So the markets are up a little bit. We got a vol up a smidgen, and I'm not looking at the NASDAQ vol, but obviously the VIX. So maybe that's helping us out a little bit. I think we'll just stay the course. No massive reason why we would want to adjust this trade. I'm hoping to get a little bit of a move to the downside, and so that we can roll into a long put spread. And we might even sell some shorter term options against it. So it would be kind of a calendar long put spread, otherwise known as a diagonal trade. So that's what my consideration is, but I do want to get a little bit of a movement, like maybe a 2% movement to the downside in the Qs is kind of what we're hoping for. Apple is a big driver of that. Apple's flat. Apple had a little bit of a bounce back last week, but there's still issues and concerns with what's going on with China. And another big one that is going to be in the NASDAQ at the end of the week is going to be Adobe and their earnings announcement. So that can be a driver. Also, they're not a huge part of the NASDAQ like Apple or Microsoft, but still that is a stock that I think a lot of people will be watching, mainly because it's kind of considered to be a part of the AI trend. And that's part of the reason why it's had a strong move to the upside. So kind of sitting around waiting to deploy some capital, if you will. And on Friday's show, I took a hint that maybe we'll look at some more stalwarts in the marketplace and try to spend some time thinking about stocks that we might want to get long going into the end of the year. And the seasonality in the marketplace is scary, so it's a little bit hard to do. So if I do want to go long some stocks, I want them to be in some of the industries that are doing fairly well. We looked at FedEx, but honestly, I looked at the chart in FedEx and I didn't really like what has happened recently. We had a little bit of we had a downturn where the 20-day crossed over the 50-day. Not that that's a huge thing, but that's called a death cross. So it's strong words. And now that the stock is trading below the 50-day moving average, there's still a fairly decent gap all the way down to the 200-day. So I decided to change things up. And I'm looked at another dividend yield stock that's in the industrials. It might be taking advantage of some of the things that are happening with infrastructure and just construction in general. And that's Caterpillar. So I talked about Caterpillar a long time ago on the show, and I always like to do a little refresh on it. And honestly, I'm not really sure. We're long a put in the QQQ, so it's kind of hard to say, hey, let's go on out and get long a whole bunch of stocks here. I still would rather play that put call or that put strategy going into October, and then if I had some capital, maybe look to deploy it. But I found a stock that I would be interested in maybe doing a fig leaf in. And the fig leaf was actually termed inside the options playbook. Another way to say it would be a leveraged covered call. But I always like to say with the fig leaf, and why we came up with the name, is that you are kind of covered. So you think about a covered call, you'd go out and you'd buy the stock. But we have Caterpillar trading at 280, and I'm highlighting it here. And if we go out and look at Caterpillar trading at 280, that takes a little bit of capital to buy 100 shares of stock, right? So if you take 280 times 100, you're looking at $28,000. And then if you want to sell a covered call against that position, there's nothing wrong with doing that. It pays a decent dividend. The dividend yield's about 2%. So very solid, and they've had decent dividend growth too on that stock. Still got high demand. Their last earnings report, their forecast was solid. The stock, and I guess let's pull up the chart here real quick. And I was zooming in on the chart, so let's zoom back out and refresh this chart. Okay. So you see that we've had some strong growth and then we've kind of stalled a little bit, breaking through on this high right up here. Once we broke through that 20-day moving average, it was been strong. But if I zoom back in and I look at Caterpillar, and let's zoom into this area right here, we see that the 20-day moving average, we have not breached the 50-day moving average. We've kind of just sitting here, kind of wondering where we're going to go next. And hence the reason why we're at an all-time high. Well, I don't know if it's an all-time high. Let me go up. We're at a yearly high, we'll say, in Caterpillar. And if we're thinking about doing a trade and we see some chop in the marketplace, this is a time, this is an underlying stock where I don't mind buying something like a deep in the money call, waiting to see if we can break out above the new highs right here, right around 290, is that, or 288, but sell some premium and wait for that breakout. We had a little bit of a pullback recently. So basically, that's why I would like to look at Caterpillar and consider a fig leaf on today's show as our paper trade. And we'll take a screenshot of it and we'll come back and we'll review it at a later date. So here we go. Caterpillar. So if I'm doing a longer term option, one of the things that I always want to do is get out into the next year, just for tax reasons. So the shortest month that I would do for the expiration date would be the January expiration. We're going to go out a little farther than that. I'm going to go into the middle of January of 2024, and we're going to look at a July option contract. So let me get out. So right now we've got Caterpillar. We're October. Here's January, February, June. We got to go. So we got to do. So we're going to do a June option contract, which is 284 days away. So quite simply, we got the stock trading at 280. We're going to go over on the call side of things, and we're going to look at the delta. So the two option contracts that I would consider here is the 230 strike or the 220 strike. The difference, 230, so 230 is trading at 78. The 220 is trading at 81. I'm kind of targeting a delta right around 80. There's quite a bit of difference in costs between the two. Obviously, just by looking at the ask to the ask, you're talking about $73 option contract, $773 and a $65 option contract. So you got $8 difference, and you're only looking at about 3 or 4 delta. So I think I'm going to come down to the 230 strike. So $65, let's look on a percentage basis. 65 times 100, we're paying $6,500. Divide that by 28,000. Yeah, 28,000, we'll do it right there. So you're looking at putting up about 20% of the stock price. So that's the maximum we could lose on this trade. If we do this trade and we put this together, the maximum we can lose. Now, we can also subtract out any premium that we could sell on that. And my idea with this is that I don't want to lose 20%. My goal would be, and kind of the William J. O'Neill aspect of investing, I don't want to lose more than like 7% on any one stock. So we have a hard stop price whenever I do long calls that are deep in the money as a surrogate for owning the stock. And that's whenever the underlying stock gets to the strike price, I'm going to consider selling it. And that means that we've had a strong move down, right? The stock right now is at 280. We're looking at buying the 230. So you're talking about a 50-point move to the downside. But here's the reason why. We have an expensive underlying right now, the at the money option contract. So we're right at the money. The 280 strike call is trading for $31 at this point. We'll call it 31. We'll round down to 31. Okay. But that also means that if the stock moved 50 points today, and this is kind of where how I like to try to guesstimate what that option contract might be trading for. So if we did move 50 points to the downside, this 64 strike or the $64 option should be trading for right around $31. So simple math. If it comes down to that strike and it happens in the short term, you don't have a lot of time decay on that option contract. The maximum that you would be down on that position would be half of what you paid for that, or on a percentage basis comparative to owning the stock, you'd be down about 10%. Now, here's the flaw in that logic is that as time goes by, the at the money option contract will decay. So if the move happens closer and closer to the expiration date, that is going to hurt you more and more. Maybe you want to get out if you see this option contract trading for what the at the money is trading for right now, 31. But I have a hard stop if it comes down and hits my strike. And mainly that's because of the way options are priced. As that market comes down, all the juice usually sits right around the most at the money option contract. They have the bulk of the time premium. So you're taking advantage of the fact that you'll be selling an at the money option contract. And that's a big reason why that's my hard stopping point on the downside. And if it's down 50 points anyways, do I really want to own this underlying? Something has probably happened at that point in the underlying stock, some news events, some major things that have came out. So that's going to be our first option contract that we buy. So let's add this one. So we're going to click, we're going to on the 230 strike, we're going to click the ask, and we're going to put that down below. Now, like I said, we're in a doldrum on the chart. So let's go back and look at what option contract we could sell. That would be interesting. That means that we're going to change up this marketplace. We're going to go down. We see the September 15th. Now we're only 4 days away. That's the most recent expiration. The 13th is 32 days away. So I'm going to go right in the middle. I would like to sell something right around 15 days. Let's see what we have here on the 11-day option contract. I like to try to target like a 2-week option, but we're kind of right in the middle, right? We've got 11 days and we've got 18 days based off of when we're putting this paper trade together. I always want to err to the side of less premium, more out of the money. So if I look at this option contract, the 290 is just below the 1 standard deviation move. And on the TradeHawk software, the shading is highlighting about where a 1 standard deviation move is at. So I'm going to avoid, well, now it just clicked, and that's right. So we're right here. If I look at the delta, it kind of gives me a hint. It should be right around 16. That's for a later date. Actually, we talked about that on the Options Guy TV that we did on Labor Day. We did Education TV on that day. But we talked about where delta is and relative to a 1 standard deviation move. Okay, so 292.50 is the strike. I like the price of the 290s, right? Trading at over $1.30. But if I was doing a covered call and I own that underlying stock, I would probably sell the 290 strike. First of all, I got a lot more capital that I'm outlaying to buy that 100 shares of stock. So I'd like to bring in a little bit more premium. But instead here, I'm going to look at the 292.50 strike. And that's trading right around 85 cents. 16% chance looking at delta that it's going to finish at least 1 cent in the money on that. And so that is going to be the option contract that we're going to look to sell. So I'm going to click that button, and this is going to be our fig leaf, otherwise known as a leverage covered call. You could also just call it a diagonal. Why would it be called a diagonal? It's you're buying an option contract that's deep in the money. You're selling an option contract that's shorter term out of the money. And if you were standing on the floor of the Chicago Board Option Exchange and you were looking at the quote boards, you looked up, I'm pretending that I'm standing down in the Caterpillar pit, you would be looking diagonally on the quote boards. That simple. You got a different expiration, you got a higher strike. The line between the strikes and the options contracts would be a diagonal. And hence the reason why they call long spreads, where they're in the same expiration, verticals, because you're looking vertical on the quote board. And that's where those names come from. All right. So here's our official paper trade. We're going to buy the June 2024 21st expiration 230 strike call. At the same time, selling that same expiration 292.50 strike call. Looking to get this entire trade done for $63.90. Well, we're at 80. We're going to make it 80. Let's make it 80 to make the math simple when we come back and look at it. 36.80. We're hoping to get that trade done close to the midpoint. Never guarantee a midpoint. Phil, but that's going to be a paper trade. All right. So I guess I should have asked earlier, but if you ever have any questions, it's understood here on Options Guy TV that this is a very interactive show that we do, and we really want people to participate with any and all questions that you may have on this trade or even previous trades that we've looked at, or simple questions like what is delta. We're happy to try to address anything that you have on the show. So if you do, please put them in the chat box and we'll try to address any of them shortly. All right, so we're butting up against the time here. So at the end of the week, we're going to look at an Adobe trade, which means that we'll probably look at that on Wednesday, even though you'd usually set that trade up on Thursday because that's the trading day that they're going to be announcing earnings after the close on Thursday. And very interesting about the VIX. Usually, if you see the VIX up and you see the marketplace up, now this isn't, once again, it's only just one data point, but that kind of signals people don't really believe in the upside move. And sometimes you can get a reversal. Sometimes it could be as simple as they're just not calculating the VIX. Like it has a little bit to do with the way that they're rolling the options and the way that they're calculating it. But with that said, it's pretty, we were up over 2% earlier in the VIX and only up about a third of a percent in the SPX. So that's a decent difference between the two. And we do have these big news events that are coming at the end of the month. So that should make it interesting. All right. Well, I do see one question here. We go ahead and we'll put that one up for you. Would you ever consider selling a longer term call on this position? All right. So that's a great question. We looked at an 11-day option contract, and I actually want to, because we're right in the middle, right? I'd like to try to target a 15-day option contract somewhere a couple weeks out. But I'm usually going to err to less time as opposed to more time, because here's the big thing about the fig leaf, and that's the reason why we have the name. And we actually do have this, the name in, if you go to optionsplaybook.com, you scroll down to the bottom of the fig leaf section, we do tell you where the name came from and how we came up with it. But with that said, you are kind of covered in that if you got a covered call and the stock gets called away from you and you fall asleep, no big deal. You sold your stock at a higher price, you got a gain, everything's all hunky-dory. If you got a fig leaf on and you fall asleep, guess what? Somebody's going to be calling you because you have to do something. You are long an option contract and you owe 100 shares of stock. You have the right to buy that 100 shares of stock at a lower price, but do you want to exercise your option contract? The answer is usually no. Why? Because if you exercise your option contract to buy the 100 shares at a lower cost, you may be giving up a ton of time premium that's still left in that option. So what the normal circumstance would be is that you would sell your long option the day after you got assigned, you'd sell it, generate the capital to buy the stock and give that stock up for that assignment on that short call. Hence, capturing any time premium that's left in the long option contract, but still making good on your obligation. So you are covered as far as the brokerage firm is concerned, but you got to do a little bit of work. And that's why we like to say you're kind of covered, and hence the name fig leaf that we came up with. Okay, so long answer to a very short question is I want to err on on that option expiring worthless, right? I don't want to be assigned. So I don't like to go out longer term on these option contracts. It gives more time for that underlying stock to have a spike up in that stock price. I don't want to sell them around earnings. That's one of the biggest times that I don't want to do a fig leaf and sell. I'm going to probably skip the expiration of their earnings announcement. I might sell it so it expires just before. So the way that I choose my options that I'm selling on a fig leaf is much different than the way that I would approach it on a covered call position in Caterpillar, where I just literally own the stock outright. So the answer, would I consider selling a longer term call? Very rarely would I. I may do it if I get closer to the expiration date, let's say there's only 30 days left and I've stayed in this position for that long, if that happened, well, then I might consider selling a longer term call to literally make this a spread. And that would be the only reason why I might consider doing that. But on the initial trade of my fig leaf, I very rarely look at longer term calls, and longer term being, I'll call that 30 to 40 days out in time. All right. Do we have any other questions? Nope. All right, that looks like it's it. Another great edition of Options Guy TV. We'll come back this Wednesday, and then we'll look at a more speculative trade in Adobe. We'll review our position in our put. If we get a little bit of a downturn, we'll be able to adjust that position and roll that into a long put spread. If not, oh well, I guess we got to consider what we're going to do next if we see that market continue up and show some strength. That's it. Please click subscribe, ring the bell, and pound that thumbs up. It helps us out here on Options Guy TV, and we'll see you this Wednesday at 11 a.m. for the next edition of Options Guy TV. Thanks for coming, everyone.